and welcome to the briefing for March year-end reporters. The full accounting reminders are available on Viewpoint, but over the next few minutes I will explain the key issues for each topic. If you want to jump to a particular section, the timestamps are on the screen now. With regards to Brexit, for some entities, the implementation period completion date on the 31st of December might introduce additional risks that should be factored into reporting. An additional consideration is that there will be a change in tax status on IP completion day. Various tax exemptions and reliefs arising from EU membership will no longer apply to UK companies and, in some cases, to other EU companies transacting with the UK. Therefore, it is important to identify these exposures and consider the tax accounting consequences. Changes have also been made to UK company law as it applies to corporate reporting in order to address issues arising from the UK's exit from the EU, with some important changes to exceptions and exemptions that will be relevant for some companies. The IASB have issued an IFRS 16 amendment which provides an optional practical expedient if certain conditions are met, for lessees from assessing whether a rent concession related to COVID-19 is a lease modification. Lessees can elect to account for such rent concessions in the same way as they would if they were not lease modifications. In many cases, this will result in accounting for the concession as a variable lease payment in the period or periods in which the event or condition that triggers the reduced payment occurs. On to IBOR reform. Since the financial crisis, the replacement of interbank benchmark offered rates, known as IBORs, has become a priority for global regulators. This is an ongoing process and is happening at different speeds in different parts of the world, but is expected to happen by about 2021 or 2022 in most parts of the world. The IASB has released 2 phases of amendments to give reliefs from the effects of IBOR reform. Given the pervasive nature of IBOR-based contracts, the reliefs could affect companies in all industries. The Phase 1 amendments, issued in September 2019, cover amendments to IFRS 9, IAS 39 and IFRS 7 that provide temporary relief from applying specific hedge accounting requirements to hedging relationships directly affected by IBOR reform. These amendments are mandatory and should be applied for annual periods beginning on or after the 1st of January 2020, with earlier application permitted. The Phase 2 amendments, issued in August this year, cover amendments to IFRS 9, IAS 39, IFRS 7, IFRS 4 and IFRS 16 that address issues that arise during the reform of an interest rate benchmark, including the replacement of one benchmark with an alternative. These amendments are effective for annual periods beginning on or after the 1st of January 2021, with early application permitted. Accounting correctly for supplier financing arrangements has attracted significant attention from regulators since the failure of Carillion, with focus, amongst other areas, on a company's source of finances. This includes whether a company has made material use of supplier finance arrangements, if this is transparent from the annual report, whether the related balances are appropriately presented as bank debt or trade creditors, and whether subsequent cash flows are appropriately presented. In the UK, the regulator has indicated it expects better disclosures around supplier financing arrangements than companies are currently providing. The accounting for supplier finance arrangements will depend on the exact facts and circumstances relating to them. We continue to see a large number of questions on the restructuring of issued debt instruments, for example loan facilities or bond financing, and modification of derivatives to take advantage of low interest rates. This is a complex area of accounting which can require significant judgment. To assist companies in understanding the potential issues, some of the key accounting considerations under IAS 39 and IFRS 9 are summarised in our accounting reminders. These include determining whether the new and old debt have substantially different terms, the treatment of a gain or loss on modification or extinguishment of the debt, the treatment of fees incurred as part of the renegotiation, the use of an intermediary, and the modification of derivatives. In January, the IASB issued educational material to remind entities preparing financial statements in this difficult environment on what needs to be considered when providing the going concern disclosure required by IAS 1. The document focuses on judgmental areas where there are significant doubts over going concern, but where mitigating actions are sufficient for going concern to be appropriate. Where material uncertainties remain, it highlights the need to disclose the uncertainties, as well as information about the judgments made to conclude that going concern is appropriate. Reference is also made to the agenda decision in 2014, which concludes that when mitigating factors are in place, and it has been concluded that there are no material uncertainties, such conclusions would involve significant judgment requiring disclosure under IAS 1.